lot of people. I have not been introduced to most of you. The professor knows some of you. Let me introduce myself. I am from Belgium. My profession is fiscal counsel. In German, that is Steuerberater. In Hungarian, I wouldn't know. Do we have taxes in Hungary?
No. We have Copenolle.
Thank you. I became involved with a professor at a rather late stage in about 2003. Before that, I was trying to make money on the NASDAQ. Familiar to anyone? I think so. So, that means that most of these people in the room know what short and long means, right? We've established that. What I would like to know from you, very shortly, is what it is that you're doing in 2 words. Starting on this.
Selling gold.
I know what you get out of it.
I'm an assistant at the IT company.
Right?
I'm a student.
You're a student? History? Yes.
I'm retired.
And you did before you became engineer? All right. A mathematical mind.
Since I retired, I decided to invest.
Right. The person of South Africa.
Most of the time I stay in the garden.
Sorry, I didn't.
I work in the garden.
I believe that. And otherwise?
Otherwise, here in Europe, I'm working in acquisitions.
Mergers and acquisitions.
Due diligence.
Right. In order to perhaps financial analysts and merger and acquisition specialists for
For the company, the investigation of the company, identifying risks, evaluating the balance sheet, P&L, profits,
Right.
sustainability.
He is working actually for KPMG.
KPMG, right? Yes. One of those big 4 or big 5 used to be.
Big 4. I work in the freelance basis, so
That used to be my dream job. What you are having. Used to be. But I've been put off. Right.
I'm assistant of the company.
Sorry.
I'm assistant of the company. Investment company.
All right. The same type of job, right?
I am CPA in Portugal and I am also planning.
Okay. Financial jobs. So the gentleman next to you is an engineer, I believe.
cameraman.
Yes. The person standing up is the cameraman and Dublin as
Manufacturing machinery, manufacturing machinery.
right.
Entrepreneur.
Sorry.
Entrepreneur.
Entrepreneur. We come to that. Yes. An inventor, I suppose.
But not considering spread and profit too much. Not yet.
Yes.
Right.
I'm a young engineer and electrician, and as a hobby I study economics and accumulate gold and silver.
Excellent. Normal person like one of us, yes. The gentleman from Australia?
Yeah, I do software engineering and I also accumulate gold and silver and trade futures.
Right, right.
Yeah, trader for a living.
You a trader?
Yeah.
University background or
Yeah, both. Yeah, I'm going for the bank.
trained economist?
No, I'm trader, economist also, and working for a bank.
Right.
I'm a broker for equities and equity derivatives in Hungary.
Okay, you also went to school or went to university, had to study whatever,
So I spent
economics.
12 years on the market.
All right.
So I'm head of equity sales desk in Hungary for a 4 years now.
Excellent.
Working in a local bank, also as a salesman, FX and commodities, bit of equities.
Okay, right.
Like working in logistics, formal, have an expertise in finance, worked in a bank, like a guys, 1.5 years. And I'm an investor as well, going to
We all do investing. Well, if you have one, huh? And
Martha, tell them what you're president of.
We own a condo company.
excuse me.
Very correct.
And you have?
Right?
Yeah, she has it. You get it.
You'll get at the bank.
And I'm currently writing on these issues, gold and silver.
Okay, but I believe your background is sociology.
Well, I would say it's more political science and that
Political
history.
science.
Yeah.
Okay. Right, I have now an idea, which is important because I may be speaking above somebody's level or below somebody's level. Please forgive me if I do that. It is not my intention to obfuscate you or to, speak in such a small way that you can understand easily. I don't know. That's why certain terms to the financial people will be very easily understood, and I need to make sure that everybody's with me. Good. I used to live in South Africa for 13 years. I got my degree from the Loránt University, which is now called Johannesburg University, I think. And I was taught the name of Keynes. Never to forget. That was the big hero at the time. And going back to Belgium, I was forced to study economics again because I could not validate my South African degree in economics and as an accountant. I could not start in Europe as an accountant. I had to prove that I could do European accounting, know some European laws, and therefore I was forced to enroll again at the age of 40 odd at university again. Bureaucracy. Now you know a little bit about me. And I will start off by giving you a small TV show or a presentation, and I will recapitulate on the professor's theory of of time preference, and I will talk about productivity of capital, and I will visualize it in what the professor has called his hexagonal model. I have taken a bit of liberty with the word hexagonal. We all know, the engineers certainly know what a hexagonal means. You have 6 corners, right? I have taken a little bit of liberty in keeping the 6 corners, but rearranging them a little bit.
Financial engineer.
We know that
I'm not an engineer, you can laugh at my model, whatever.
financial engineer is different from technical engineer. This is what the reference.
This would be a classical hexagon, right? Formulas. Good. I couldn't work with this. It took me a whole 3 minutes to come up with this. You could stare at this. it will become clearer in a minute. But I've taken the example, cut them in half, rearranged the portions. And that will become clearer as I will explain in a minute. On the screen, I have committed crime. My crime is that I cut this piece from the Wall Street Journal. So this is an infringement of copyright. And I couldn't care. I want to start this portion with an ad that appeared in the Wall Street Journal. Can everybody see this? Or should we dim the light a bit? We dim the light a bit? Is that okay for the cameraman?
If you leave the background.
Maybe you know which should see this.
I think it's upstairs.
Yeah, those are upstairs. You have to go
It's
upstairs.
upstairs.
Yeah, you have to go upstairs.
Oh, well,
Yeah.
leave it.
Yeah.
It's too hot upstairs. This little ad signifies to the Wall Street Journal at least that there was a difference between knowledge and understanding, and they made it clear with this picture. I will use this picture a little bit later, but I thought it would be a nice touch in what I had to say. Good. I had to study economic theory twice. Once in 1985, odd, and last year I had to do it again, grudgingly. And one of my textbooks had a nice picture of the economic machinery. Again, little crime of plagiarism. I don't know who the artist is, but as you can see, this machine was designed to show you monetary economics, and it looks very complicated, isn't it?
Speaking of financial engineering.
This is financial engineering, and I've put the little windmill next to it. Meaning, it is useless. I was hesitant in putting up this next slide. Some of you are familiar with it, maybe a long time ago, or not so long ago. I see nodding faces. The ISLM model, macroeconomics. I had to study it twice. Don't ask me what it is because I still can't explain it. It is the equilibrium model again. IS stands for apparently all points where investments and equal savings, or where investments are in equilibrium with savings. And through a very complicated explanation, which you can find in any book from Professor Frieden, probably, and Professor Krugman, and whoever, you can look at it. If you understand that, you can come and explain it to me. It's conventional knowledge, and once again, the little window. This is what I think of the ISLM model, having written exams on that twice. Now, in 2003, I stumbled across the hexagonal model. Now, the professor has never seen this. Both Professor, you wrote this. This is what I will briefly explain. We'll go through that rather briefly because this is a visualization of what the professor has just explained. This is the interest model and also the productivity of capital. If a schmuck like me can understand the hexagonal model and I fail to grasp what the ISLM model can do for me, especially after the NASDAQ, I thought I knew it all. I was going to make a killing. Not. I didn't understand what went wrong, so I went back to study and found the hexagonal model, and then a little light went on. It was a lot clearer to me. That's why I think the hexagonal model, the interest model that professors thought about is a lot more workable. On the left-hand side, on the bottom part, we see the two words, a nutant with a D and a nutant with a T. On the axis, I've drawn age. The annuitant with a D is the younger person. The annuitant with a T is the older person. They are the basis of this whole model. The annuitant with a T is the older person. He's got some wealth, and his problem is trying to convert this wealth. And I've made a mistake there. Wealth should be into income. The annuitant with a T is typically the younger person, and he's trying to convert income into wealth. We've seen this in the previous lecture that the professor has touched upon. I don't know if you have read all this model on the internet with the professor. Have you? Is this making it clearer? A visualization makes it clearer. Right, we've covered this. I should say, in the time of the Greeks, 2,000 years ago and 2,500 years ago, the working people were the annuitant, and the old people, the annuitant with T, they both had a problem. How to make savings for the young persons and how to convert savings into wealth for the older person. That's why we have drawn on the left-hand side the zero for zero interest. If you do not allow zero interest, there is direct conversion of gold for the old person to dishoards gold into income, and for the younger person, he has to hoard by converting his productiveness, his labor, and try to save that way. Enter interest in the system, and here it becomes interesting. Under the older system, there was nothing else to do. You can only convert your gold into this hoard your gold, or try to hoard your gold for the younger person. That was the Pareto optimum, since nothing else was allowed. And a Pareto optimum, is that clear for everyone? Yes? Pareto optimum is the optimum point where you cannot do anything else without harming other people. In 2 words. In a century-led economy or an economy where there's no interest allowed, that would be it. If you enter an inventor and the entrepreneur, as the professor has explained, there could be a direct relationship. the inventor is also the younger person. The entrepreneur is the older person. What's the capacity of the inventor? The inventor has brain power, if I put it in a nutshell. The entrepreneur has willpower. And on the bottom part, the annuitants have capital. And they could make an agreement, direct agreements. The younger generation could make an agreement amongst themselves, the inventor and the annuitant, at a certain amount of interest. And they would form a partnership. Because they both need to accumulate wealth. So they combine some capital and some brain power. Meaning, coming back to the straddle, there would be short wealth and long future. Right? Correct me if I'm wrong. Yeah. On the other side, briefly recapitulating what we have said so far today, the older generation, they're long capital and short income. Now there's another straddle. Is everybody with me? If you're not with me, stop.
That makes very good sense.
Make sense? Alright, so this model still stands. Because this is the first time I put this on the screen. Enter the next phase, which is the capitalist. I should say maybe that the basic framework would be, of course, the capitalists in the bottom, the annuitants. They are capitalists also, but we make a distinction in the sense that the annuitants could also form a relationship amongst them horizontally, that is, because they could be father and son. And if you think this model is not is far-fetched, think about those firms that are called father and son, Smith and Sons, Lawyers Incorporated, or whoever with sons, shoemaker, horsemaker, whatever, those old professions, and the sons. That would be an exact example of that. So it's not far-fetched, it is real life. Now, there are no symmetrical positions. That is important because there is a lack of symmetry in the model. The providers of capital on the bottom, they are dominant. Why are they dominant? Simply because if a politician or a system comes around and forbids interest, like we have religious systems that forbid any interest, usury they call it. So they outlaw interests. Well, what happens? The bottom part survives because they can convert back to the hoarding and the dishoarding. And who loses his position? The inventor and the entrepreneur. They will be jobless.
Question. Isn't usury interest on interest? Or is usury really a similar this interest, based interest on provided capital?
Users of capital.
Usury would be, I would define usury.
No, that has nothing to do with usury. There are users of capital and providers of capital. Which is which?
The providers of capital would be on the bottom and the users would be on the top. Was that your question?
No, that is clear. But it was the term usury. You referred to this Catholic Church and legal interest have been forbidden.
Yes. And
I looked it up a little bit and I understood that the interest on interest was forbidden, which is killing the system right now.
Right.
But basic interest, also a long time ago, was was at least discussed, because this means this is what providing capital is available and there are good interest, but the interest on the interest, which is then exceptionally depleting the system.
I grant you that I have to make this in a nutshell. Under Islamic systems or
There is no interest.
there is no interest. You're not allowed to. So I will make. I'll have to make it very generally applicable because it's a theory. Now, in the 17th century, we have heard the example of Leonardo da Vinci, who was before the Reformation and before the 17th century. There was no capital providers, there were no capitalists. But what happened in the 17th century? We have the advent of the corporation to start. And here's where history comes in. Because the professor, probably very knowingly, just described our historic economic system and how it evolved. From what? We have the first capitalists, let's say, around in the 17th century, and the most notorious ones were the Mississippi Scheme. Does that ring a bell? Should I go into the Mississippi Scheme?
Yeah.
That was, well, from a point of the capitalists, that was the formation of a company. Never in history before you could make a company. Look, it was the South Sea bubble, that was almost the same thing. It went bust. But people for the first time were not trading in their own private capacities, they were trading as a company. They went bust in a big way. That's beside the issue, but the advent of the company as a separate entity, as a legal entity, that was important. Because that is the advent of the capitalist. Since then, 300 years later, we all know that we can form separate companies or separate bodies, legal bodies. And I will have to go a bit faster. We have also the investment banker. Before we shoot all bankers, which we should not do, that is an important part of society, the investment banker, because he is the go-between for all the four corners of this system. He basically buys at the bid and sells at the ask, or the floor and the ceiling. And he takes orders from all corners and converts them quickly. This capitalist and investment banker facilitate the whole economy. We have here an explanation why our society has evolved in what it is today. All sorts of combinations of these parties are possible. The main sense is, if we have a little bit more competition from the providers of capital and the capitalists, the competition meaning they can provide capital, it brings down the interest rate. Because if you do not have a capitalist, think before the 17th century, interest rates were enormous. They were up in the 20s. Am I right? I'm not a historian. Any historians among us?
The point is that brings down the interest rate in a natural way, not through a force of government or pressure of law.
The hexagonal model that the professor has thought about or built upon is a natural model under a gold standard, not where a central banker. There's no central bank here anyway. This central bank is out of the picture. Forget it. It's not there. This is under an unadulterated gold standard. So the floor, or at least the interest rates and the floors come down. And through capitalists, we have more capital, and it's more easily available. From 20% we've come down since the 17th century. That makes sense, and it explains why we are where we are today. Yes?
Why have been in previous history, 17th, 18th century, where the world economical exchange system was based on the monetary metals interest so high? Because the competition was lacking between capitalists and the investment bank. How was it? Because it was all the means of exchange at that time, wasn't it?
We should we should enter the real doctrine, which is totally a different subject, isn't it? Because the real bills will come in, and that is a discount rate, which is separate from the interest rate. But it would help enormously in the economy. But that was the assumption of previous sessions. Unfortunately, time is limited. Now, you've seen the bid and ask, which Carl Menger observed, and which all the Nasdaq traders will also have found out that there is such a thing as a bid and ask, and anything you can imagine in between. And you can put in orders. I mean, it comes naturally. And conventional economics makes us believe that the average of the bid and ask, that is where we are, and we can draw a straight line and forget about bid and ask, which is too simple. Because that is discarding the hexagonal model. And they can simply do with one line an equilibrium line that doesn't exist at all. So this is, and I still have a few slides on the floor. This is the definition of the floor. Theoretically, I mean, you could read it also. The floor for the rate of interest is determined by the rate of marginal time preference, which is the subject of the previous lecture. It is the rate at which the opportunity cost of holding the bond becomes critical to the marginal bondholder. The bondholder, that is those are the capitalists at the bottom. And obviously, if I put this into layman's terms, it would mean, do I hold this bond paying 4%? Or do I do something else which pays 5%? And you do arbitrage. You may not call it arbitrage, but this is what you are doing. Giving short something else and go long something. That is arbitrage. Now, this is the definition of the floor. The opportunity to carry wealth in the form of a present good rather than a future good, which is a gold bond. That would determine the floor. It will never crack down the floor because people will never allow the floor to tumble. And the floor we will see later is long. The ceiling, that is different. Ceiling for the rate of interest is determined by the rate of marginal productivity of capital, which is the second half, and that is simply the rate at which the opportunity cost of carrying the capital stock becomes critical to the entrepreneur. Because he has to decide, in other words, do I keep my stock? Do I keep in this business? Or is it just too damn difficult and will I leave this business? Once you have capital and you can invest, you can invest in gold, bonds, safe, or you can invest in risk-carrying assets such as stock, to make it simple. And the advent of the investment banker makes it easy. Today we have little screens and platform. That is what I'm talking about. This is what the professor is talking about.
Peter,
Yes.
What is the definition of a gold bond in this system? Who issues it?
A gold bond is a contract.
Okay.
Somebody issues it because he wants to attract capital.
Okay.
It is the company that wants to attract capital. And there is again a number of entrepreneurs with their own capital who want to attract other people's money. And they would, if in an ideal world, under unadulterated gold standard, they would attract other people's gold, and the dividend would be payable in gold. That's a gold bond.
Okay, so it's still a bond in the sense of an IOU, except it's payable in gold and it is
Interest and capital.
Defined in gold.
Yes.
Okay.
And paid.
Attracts gold and pays gold.
Yes.
Okay.
And you can make it in dollar terms or euro terms. Basically, what I've understood from the professor is forget dollars, forget euros.
Yeah.
Count in fine grains.
Sure.
And weights.
Yeah.
And you will not get confused simply because that is basically as marginal, the marginal utility of gold is constant.
Sure.
And it's not made of rubber. A dollar or a euro, how long is a meter? Well, it depends how long. How much is a dollar? Well, it depends.
So that's its weakness, Pete.
That's the weakness, but you cannot do that with gold.
Yeah.
The alchemists have tried. That is a gold bond. The ceiling is defined by the marginal productivity of capital. Another visualization, if you want, the ceiling, the floor. What do people do? They will sell bonds, so they're short bonds, and buy stock. If the interest goes down too low, they will keep on selling bonds and buying up stocks. And the entrepreneur will do that. Interest rates are too high, people will sell stock and buy bonds. That will be the ceiling. Yes?
Sorry, shouldn't the bottom one be sell bond, buy gold? Or? I was going to ask the same question.
Under horizontal arbitrage, yes, you could.
Maybe it's a gold stock.
It depends on what kind of strategy you're doing. You could do that among horizontally between gold and bonds, but you're staying in gold.
Because previously you said the floor is marginal bond holder selling bond for gold, taking gold present there. So that's why I think it starts a little bit with the entrepreneur selling stock and buying bond.
There is a sky between gold and immigrated, for example.
No, this is, I understood selling the gold bond and buying the stocks. Because this is not a hot air stock. This is really some company that is delivering value.
Those people who want to buy stocks, buy stocks. Yeah. You can exit the market altogether and stay in gold, meaning that if you sell gold bonds and you buy another gold bond, that's a totally different arbitrage because it's horizontal arbitrage.
The question of arbitrage between gold and gold bonds is time preference.
Yes.
And the arbitrage between stocks and bonds is productivity of capital.
But is it on both sides productivity of capital? So at the bottom as well? Because I thought the floor was you sell your bond and you buy gold because you don't have to have a low interest rate.
Let me go through the next 5 slides and it will become clear what types of operations you can do, because obviously you can do lots of operations. Stay in gold, get out of gold, into bonds or into stocks or whatever. Now, the entrepreneur does, this is the vertical arbitrage.
Can I just ask one question? Just have difficulty identifying the capitalist in physical reality. Is the capitalist the entrepreneur? Is he the director? Is he the shareholder? Who is he physically in this world?
Obviously, the entrepreneur has a little bit of his own money because he's also on the older side. He's got his own money. If you have a company, you have your own capital and you have other people's money. foreign capital, not foreign from another country, but I mean, what is the word in English? Your own capital and what's on the balance sheet? What do you have? On the top side, we have your own equity and basically well, it's a liability. Now,
so you say with capitalists, so you say the blue liability.
yes, I mean, the entrepreneur has his own money at stake and some other people's money at stake.
But investors?
So the capitalist is.
That's a broker.
Sorry?
This capitalist is a broker. That's somebody who's people bring money together. That would be a capitalist. And they borrow their capital to other inventors and entrepreneurs to make it productive. But they don't take risks. They're just making a living on the ceiling and the floor. They do, that's their business. They don't. The capitalist in this picture is not an entrepreneur. He's not. He's that's a banker. Call it a banker.
Who's the market maker?
Yes, market. Yeah. Market. That's why he can buy the floor and sell the ceiling. All right. I'll have to do this quickly because this is vertical arbitrage. I've made it in yellow terms. The floor vertical arbitrage is what we've seen here. We need to introduce vertical arbitrage in the definition. It determines your net earnings, and you need to basically see what the PE, the price earnings is of the bond, and the price earnings of the stock. The price earnings of the bond is very fixed. The stocks can float. And the capitalists in this picture would make a living out of that, but also the entrepreneur. The entrepreneur can also do that. I will have to go a bit faster, otherwise I'll never get it. This is where I'll start. I should start here before. The marginal productivity of capital is not an easy concept. At least it wasn't easy for me. I had to read it a few times, and maybe I'm the only one with this problem, but finally it dawned on me. If you have two possibilities here, you have capital invested here on the left-hand side for 10 years, and it yields 5%, it would reach, it would give you cash flow, the annual cash flow is 209. And on the other side, it will, at 6%, it will give you a cash flow of 211. Obviously, you choose times 0 for the higher yield. At certain levels of interest, this is what would happen. Let me explain what I mean. If an entrepreneur has capital and is deciding, like you have said before, some of your friends have an idea and they made it into a business, they may have the combined role of inventors and entrepreneurs and put up some of their own capital and attract other capital. But basically they are four corners. You make a bigger operation and you can clearly see 4 corners and maybe 6. But a small operation would be all 4 corners into one person. Now you have a choice. You can go to the bank and say, all right, I have $1 million, whatever million, and the bank gives me, or the gold bond gives me 6 or 5, and I have an idea which would yield 6. Fine, let's do it. At that moment, you have invested your capital. Turn the hat, I should say. At this moment in time, it is important to see that your fluid capital, your liquid capital, has become fixed capital. You cannot convert it back so easily into money. You've bought this building, you've bought your machinery, whatever, taken a patent, paid patent lawyer a fortune, whatever. You cannot convert it back without a loss. Therefore, it is important to see that if the interest rate would drop, say you are invested at 6% and the interest rate will drop, you have an opportunity cost. You have an opportunity cost. It's not so easy to understand. And this is the problem of main economics. At that moment that you are investing, your newcomer can invest at 5%. You have done some investment in an opportunity. It is paying. You are attracting competition. People after you can invest in your business or can invest in the same type of business at a lower cost. You got your money in at 6%. You made, 18 months later, whatever time later, you have competition. And under a free market system, they will win. You will lose, and this is what will happen. Eventually, when interest rates drop, and they drop continuously, you will say, oh, I've had enough, I cannot continue with this, because other people in the free market competition, there is so much competition that it is called atomistic. Which is an economic term, atomistic, which means you're a price taker, not a price maker. You cannot determine the price of your product, you take it. And because the competition is financed at a lower rate, they determine the price, not you as the first one. Because they determine the price, your capital will be eaten. And at a certain moment in time, you have to decide to continue or not. If you do not continue, this is what will happen. That's the relevance of
allow these two comments. If you approach that, and I fully agree on that, from the pure financial economical point of view, it's absolutely correct. Only one comment, it has a determination that you have landed on fixed rates, otherwise you were participating and benefiting from the lower rates as well. Secondly, and that is a key comment of mine, I just look at it also from the opposite view, or differently. I would very much question myself, but also any entrepreneur who sets up his business shop on this marginal utility already. If he cannot be pretty sure that his value creation is far above floor and ceilings of interest rate fluctuation, he should not enter the business at all.
That's right.
Because he's set on the mercy of the banker from the beginning to the very end.
It's finance 101.
How many people are in that position?
Yeah.
I think most successful companies, and that is still the majority. And the most successful go anyhow with own capital.
Yes.
The most successful companies in Europe and all in America, they don't go to bankers in decades.
And 100 years ago, we couldn't hedge that. You can hedge for every major event, even if it was real.
Just comment. So the economical theory, I fully buy and agree on that. But I just want to add this point: the whole economy, the very creative economy, has some further inputs.
That is a fully valid point, which is, and you're describing vertical arbitrage. That opportunity that attracts a large enough spread, and you're pretty sure maybe you could put it in concrete that nobody else can touch it through a monopoly or whatever, some of that. Or maybe brain power, which is possible. The willpower and the brain power of the inventor combined can give you such an advantage that you may survive for another 100 years. Possibly.
I think now we are making floor and ceiling in a different way. We're touching, if we move in this marginal account, the ceiling of a financial where it should not enter, and everybody is trying property, but that's also not reality. I'm just bringing in the point of medicating starting up business that we have here on the slide. There should be enough security margin that gives you room to move, because interest rates will change. And when you start your business now, you never will know what the intent is. Will interest go up? Fundamentals most likely, but it can go also the other side. And if you put your vertical arbitrage in such a narrow margin of error, I would say it's not very secure in my business.
That is true. I grant you that. I grant you that.
But there's nothing against the concept.
No, that's why.
It's just where we have to look from this interest determination point of view. That is our key point.
The next time I do this presentation, I will incorporate your remarks, because this is my first time.
It's great.
It's a trial.
The visualization, everything is great.
The next slide is basically borrowed from classical mathematics or economics. Marginal. This is probably one of the better examples. It's a bit mathematical. Most people who have done mathematics and economics would have no problem getting it. You have declining marginal productivity in anything, also in capital. That is what is depicted here. The more capital, you cannot forever pump money into a business, and at some certain stage of business, on the bottom half you can see it's stopping out, and that is when the marginal productivity will drop to zero. The next investment or the next dollar that you invest will yield will yield zero. That's the maximum. This slide just to clarify marginal, what it means to be the marginal investment. I will have to refer back to my notes. Maybe just one clarifying remark here. The hexagonal model describes the interest rate cycle in such a way that interest rates are never fixed. The top, the bottom floor do fluctuate. The ceiling, the mechanism of the ceiling and the mechanism of the floor, they're two different mechanisms, and that is what the interest rate cycle is all about. Capital is productive at a certain rate. You may have an advantage. Some of us may not be so lucky. But in general, we are all economists in the sense that we participate in daily life. And that makes us economists, because we have to decide, do we take our savings and start this business, be it small, large? Do we spend our income and spend it in the shop or not? Do we buy some saving product from a bank, or do we buy some gold? Again, those are economic decisions which makes economists of all of us, and that is why it's completely ridiculous that Wikipedia mentions that the professor is not an economist. That would be completely ridiculous. We are all economists. I see that my time is running out. Maybe to clarify on your remark, the next slide would clarify who is basically an agent. The entrepreneur is an agent, and we see this in daily life. The CEO of a big corporation, Copenolle, is basically an agent, both for himself, he's got some money in there, but also for the capital providers, the people holding the shares. And this model explains beautifully it's a simple model, and it explains very difficult concepts. Providers of capital are marketing, everybody's got a role to play. Now there is, the professor made some remarks on von Mises, or Mises himself. Von Mises is sometimes used. Mises. That there is a problem with simply the explanation that Mises has given on interest, basically. And I read literally from my notes here, which will also be provided to you. The problem is that Mises fails to make it clear how the discount on future goods should manifest itself. Meaning that there's a market for apples, there's a market for commodities, portfolios, whatever, commodities, anything. And there is also a future market, but the present price of a future good does involve an interest rate. Now this is now a circular argument. This is the mathematical description of present value, or if I can, you can write in the future value also slightly. I have to slightly change this. The professor will recognize this.
No?
No? Oops. Now I have to explain this. PV stands for present value. Large A means that there's a certain, it's just the cash flow. The cash flow of a certain number of years, and years. So if you invest in a future market, there's a certain product which would yield certain, at an interest rate high. This is financial algebra, and the problem here is that in order to get to the present value of a future good, you need an interest rate. Otherwise, you cannot get there. Is that the zest of the argument against Mises? I think so. Because Mises said we have a market today and a futures market, but he fails to make the connection that you need an interest rate to get there.
Yes, and economists also use inflation is just an interest rate because it always real.
Exactly. I will not go into this. I'm not a mathematician. I had to get this again last year in exams. Maybe I could smack some people by trying to be intelligent and put this up. Forget about it. What I mean to show you is that you need an interest rate in order, a discount rate or an interest rate, in order to get to a future value. How will you value an apple or a commodity today if you don't have a discount rate for the future? How will you make a future price if you don't have an interest rate? It's not possible. That's the problem. So we have a problem with the theory of Mises, which was a small circular reason. Professor's hexagonal model does explain both the floor and the ceiling. everybody's role in that. Maybe I've been too fast in this, but you can all read it on the internet in the hexagonal model. And if you wish, I will make this picture available. I don't have copyright on that, although I made it. I will have to go a bit faster on this, but this is basically the source of an income for the capitalists, and I mean the capitalists here in this picture, because both capitalists and investment bank, they are the market makers, and they have a role to play. They can buy the floor and sell the ceiling. The partnerships of the annuitant and the investor, on the one hand, don't have to be direct. They can go through the road. Basically, in layman's terms, this means you can take your bag of money, bring it to an honest investment banker, and he will make money for you.
Yeah, right.
Under gold standard, because he will find the bond for you. And the reason why you can make, this is the subject of my next presentation, the destruction of capital, because interest rates under a natural system, everybody can live in here, both the capitalist and the investment banker, because they can play the spread here. Right now, forget this, because this is not in play. We have a central bank who decides who earns what. And immediately, the speculation role, or the speculation hat, comes up, and obviously they do it. So entrepreneurs, I should say, have three ways of making money. The first is they can do horizontal arbitrage, or they can finance their acquisitions of firms by doing vertical arbitrage between the stock and the bond markets. Vertical arbitrage is between stock and bonds. An entrepreneur with a little bit of capital himself, he will choose. What will I do? Go to the stock market? Nah. Only 50% and the other 50% in bonds. He sees an opportunity, he's shorting some bonds by selling them, keeping up the flow, and goes into the overpriced, he sells the overpriced bond and enters the stock market. And he can do that in a flash, because we have a developed market here with capitalists and investment bankers. Take those people away in the middle, that means their system is not so developed, and you're back to Leonardo da Vinci. Yes. Yes. Because then, take away the middleman here, and it's back to direct relationships. Meaning that you have much higher interest rates. Yes?
In the monopoly situation, yes.
Because they're monopolists, yes.
Yeah, it is not there. There is not a balance of power, which Professor explains very exactly.
Exactly.
Who has the money has the power.
Yes. The capitalists will bring in money, more competition, interest rates. So vertical arbitrage is one. So the second way in the source of profit for entrepreneurial profits is they can refinance their ownership of stocks by doing horizontal arbitrage in the bond market. Second source of profit would be horizontal arbitrage, meaning that they would sell bonds and buy bonds, those who yield better. And thirdly, the third source of profits for the entrepreneur would be in reorganizing the firms under his control. Now, that's it. That would be, I prefer Coca-Cola over 3M, or I prefer XYZ to that one, because they have better management. So, The entrepreneur has horizontal arbitrage in the stock market, horizontal arbitrage in the bond market, vertical arbitrage in choosing firms as well. Is that clear? Have I lost anybody here?
Kind of. Maybe could you just, I wrote this point on that because I figured you were going to come back to what you did. So vertical arbitrage, the three sources of profit for the entrepreneur: horizontal arbitrage in the bond market, horizontal arbitrage in the stock market, and but I thought you said that vertical arbitrage determines the floor of the interest rates. I thought you were going to tie that back. Maybe I didn't write the notes properly here. Sorry, what was the third? Let me back up. What was the third source of profit for the?
There's three sources. Going back to the Hexagonal model a little bit, you can do vertical arbitrage, horizontal arbitrage in the stocks and in the bonds.
Okay, but the vertical arbitrage between stocks and bonds sets the floor of the interest rates.
Yes.
Which you also said.
Yes.
Peter.
And marginal capital, productivity of capital is determining the ceiling. Yes.
Yeah, we're over the time at this point.
Don't worry.
Yeah. So what we're going to have to do is pick this up at the next session.
Yes.
No, you have number 9, lecture number 9.
Yes, which
you have to carve out 5 minutes or whatever you need to round this off then. Okay?
Absolutely, because I have...
we have a timetable to follow.
I've basically covered what I wanted to say.
Okay. Well, of course, you can say the last word, so please go ahead and do it.
I think it's very interesting. So I would first ask the question to Alec, how many minutes still do you need? 5-10 minutes? I think it's worthwhile for this, and not to cut it short now. I would not appreciate it.
Especially with the last chart when you asked if you lost anyone. I'd like to know if that buy bond, sell bond, or buy stock, sell stock was a simultaneous execution.
It can happen simultaneously, and
what's the time factor?
I'm not giving trading advice here.
I'm just asking exactly what you meant to display in your chart.
What I meant to display here is the Pentagonal model, which is critical to understanding a theoretical system that explains history, economic history. It explains the advent of the investment banker in the 17th century, the capitalist in the 17th century, the model, the way we trade right now can be fitted nicely in the Pentagonal model. Try to do this with the ISLM model and talking the ISLM model, mainstream economics does not speak about any of these people's functions here.
I'm just trying to understand what that previous chart meant. Was that you could do either thing there?
The previous chart would be this.
Yes. Where it says
Well,
buy stock, sell stock, is that you can do either one you choose? Is that what you meant there?
Yes, buy stock and sell stock means the PE of this one is more attractive than the other one. So short in this one and long the other one.
Okay, that's all I wanted to understand.
I mean, that would be what you find in the professor's text, and I'm making it visually here. Huh? Yes.
Can I ask a question? If you go back to the slide you showed where you see the hexagonal chart.
The hexagonal chart?
Yeah, all the players. Yeah. Now, what I'm trying to understand is when you have an influx of unlimited capital, counterfeit kind of capital that the central bankers create, how does that flow into this and disturb it?
Nice question. That would be lecture 9. It would. It would be the destruction of wholesale. It doesn't fit in here because under a natural working economy, gold standard, you would have a ceiling and a floor of interest with the mechanisms I've described here. Well, I've described, the professor has described, I'm just putting up a picture. The way I visualize this when sitting in Brussels and the professor was in Budapest, I've never shown this to him, this is the first time. This would be under a natural system. Under a fiat monetary system, the picture is different. And the consequences will be explained in lecture 9. And I will explain nicely, or try to, where the money goes, what the classical, or what mainstream economists would say where the money goes, and where the professors say the money goes. I will explain that, but it's a good question. That would be for my next opportunity. And in order to give an answer to you, I will take another 5 minutes. Another 5 minutes. But if you have to go to the little boys' room or the big boys' room, on the horizontal arbitrage, if you think I'm far-fetched, or if the professor is far-fetched, think of these management gurus, because this is the role they play. I believe we have Tom Peters and Peter Drucker. Those names ring a bell? Management gurus in the 70s, 80s, 90s. Where are these people operating? For most part, in horizontal arbitrage and in improving your own survivability of your own stock. How do we improve management? How do we improve a process? They think that they have invented hot water. These people are many times smarter than me. But after having read the professor's model, I know where to fit them, which is in horizontal arbitrage. That's why they picture on me. And it may be, this came up to me thinking and reading the model, and, this is the role of these people. Not to be underestimated, because this is how you keep abreast. I mean, nothing is static. These people have made important contributions in improving efficiency and making sure that you survive and increasing competitiveness. Thinking and linking back to this model, this is where you are busy.
True, and I agree, but isn't that it's a character of the free market economy in itself? Because it will not survive if you don't do this arbitrage.
Absolutely.
With the drug or without the drug.
They have a role to play, and they've played it wonderfully. We've covered this. Basically, also we have covered this because I've said take away the people in the middle.
Peter,
the economy.
The professor wants to end this at this point.
Right. Okay.
Unfortunately, we have to follow a timetable, and I thought I should end this first day of our session on the lighter note. I want to tell you a little story, a funny story, but a true story. I'm very grateful to Hungary. I am a product of this country. I was born here, I was educated here, I even finished university here as a mathematician, as you know, and my most famous professor was Frederick Rees. He was really world famous, and he wrote the Bible on functional analysis. The trouble was that he wrote his book in French, and for the rest of his life he was lecturing on that book by translating ad hoc his own book in the classroom. And the setup was this: there was an armchair 100 times more comfortable than what you are sitting on or I'm sitting on, and he was just turning pages in his book and translating it. And there was an associate professor sitting in the first row, all by himself. And there was an assistant professor at the blackboard who was writing the formulas on the table. The job of the associate professor was to nod, which meant the green light for the assistant professor to put things on the board. Now then, there was a couple of empty rows, and then a few students very zealous, very eager to show that they are following the thing, and they were sitting in the third and fourth row. And then there was nothing in the next 10 rows. The boys were playing card games in one corner of the back of the room, and the girls were knitting sweaters or whatever in the other corner of the back of the room, and that was the setup. So the professor just translated from his own book. The guy in the first row was nodding, and the assistant professor was writing at the blackboard. At one point, the assistant professor stopped writing. So the professor said, well, something wrong? No, I just don't understand. He said, the assistant professor said. The associate professor, well, I still understand it. Well, then let's go on. So they went on, professor still translated, he was nodding, and the guy just had no choice, he had to write thing. And at one point, the associate professor stopped nodding. So the professor said, something wrong? No, he said, I just don't understand, said the associate. So now the two guys didn't understand. Professor said, well, I still understand it, let's get on. So they went on. Nobody cared about the audience. So that went on for another minute or two, and then the professor said, damn it, I don't understand. Now, the professor was keeping his own timetable. He couldn't care what the clock showed. He said, oh, that's a good time to have a break, so let's have a break at this time. And they went out, and 20 minutes later they came back, and they just continued as if nothing had happened. Now, of course, we were curious to find out what had happened. So we asked the assistant professor, what had happened? Don't tell anybody. The old man turned 2 pages. So on that lighter note, I would like to close the first day, and we'll continue tomorrow. Thank you very much.